What's up, everybody? Today we're going to talk about what equity is. Now, there's a few different ways to define equity, and they're all kind of complicated, so it's easier understood with examples, but we'll go through the definitions first. So one of the definitions is this: it's the amount of money that would be returned to a company's shareholders or owners if all of the assets were liquidated or sold and all of the company's debt was paid off. In the case of liquidation, in other words, they no longer owe any debts. Whatever is left over after that is considered equity. To put it in terms of an equation, equity is assets minus liabilities. All the assets you or a company holds minus all the liabilities you have or a company has is your or a company's equity. If you were to look at a company's balance sheet, you would have assets here on the left and you would have liabilities here on the right, and then whatever is left over is your equity. So let's get into an example here. Let's say you own a business and you have a printing press worth $300,000. Now let's say in order to buy that printing press, you got a $200,000 loan from the bank and you put in $100,000 of your own money. So if you simply just use the accounting equation, assets minus liabilities, so 300,000 minus 200,000, you're left with $100,000, which is your equity in that business. Obviously, this is a very simple example, and we're only considering the fact that the only asset, hypothetically, that this business has is that printing press, and the only liability is a loan from the bank. But essentially, you can add all the assets and liabilities you want to this chart. That equation stays the same, and that is how you figure out how much equity you or a business has in any given scenario. Another easier way to understand this might be homeowners' equity. So for example, let's say in the assets column, you have your home. Let's say this is worth $600,000 today on the market. Obviously, to buy the home, you got a mortgage from the bank, you've been paying it down for a few years, and let's say the numbers look like this. So let's say you have $400,000 owing to the bank on the loan that you got. The market value is $600,000. Your equity, in this case, would be $200,000. In other words, that is your homeowner's equity in that particular property. Assets minus liabilities equals equity. A simple way of thinking about it is that the equity is the degree of ownership that you have in any asset after subtracting all the debts associated with that asset. Another example is a stock you may hold in a company that is an equity in that company. The numbers get a little bit more tricky there because you have to account for all the other shareholders, but the concept is the same. Stockholders' equity or shareholders' equity is basically on a balance sheet the amount of money contributed by the owners or the shareholders, plus any profits or minus any losses, and what you're left with is, again, equity. If you look at something like margin trading, whatever money is in the account minus whatever you borrowed or the liability that you took on from the brokerage, whatever is left is your true equity. Now, these are basically considered the number forms of equities, and there's also intangible equity. Intangible equity is basically known as brand equity. Regardless of the numbers, certain brands have an inherent intangible value because of the reputation they've built up or how they're perceived in the media or in the public. Similarly, you can have a negative brand equity. So when these food companies have recalls or these car companies have a part that's faulty, that can lead to negative brand equity. Those things are a little bit more complicated, and there are even more ways of defining equity, but for now the best way to understand it is that equity equals assets minus liabilities, and that's all you need to know for now. That's pretty much it, you guys. That's what equity is. Hopefully that was helpful as we continue to go through the basics of finance, and we'll join you next time.